There is a signal. It is not broadcast on the evening news. It is not debated by pundits on cable television. It is hidden in the dull, monochromatic columns of regulatory filings and transaction logs. But to the forensic eye, it is louder than a siren. Before every single catastrophic financial collapse in modern history, there is a specific mathematical anomaly that occurs in the markets. It is the divergence between what the ultra-wealthy say and what they do. This is the smart money signal. The mechanics of the market are cold and indifferent. For a billionaire to secure their wealth, they cannot simply sell. Selling requires a buyer. To exit a position worth billions, one requires a market flushed with optimism, a retail class convinced that the good times will never end. This is not a conspiracy. It is a liquidity requirement. The pattern is absolute. Before the sky falls, the architects of the economy quietly head for the exits, leaving the door unlocked for the unsuspecting public to walk in and take their place at the slaughter. History does not hide its tracks. It only waits for someone to read the evidence. Look at 1929. In the months preceding Black Tuesday, the narrative sold to the American public was one of a permanently high plateau. The shoeshine boys were giving stock tips. The middle class was leveraging their homes to buy paper assets, but the ledgers tell a different story regarding the titans of industry. JP Morgan and the Kennedy patriarchs were not buying. They were liquidating. They were moving into cash and gold, silently offloading their risk onto a euphoric public. Fast forward to 2007. The CEOs of the major investment banks were publicly touting the strength of the housing market and the resilience of the global economy. Yet in private brokerage accounts and through complex derivative structures, they were shorting the very products they were selling to pension funds. They knew the mathematics of the subprime debt were terminal. They did not warn you. They sold to you. The crash that followed was not an accident to them. It was a scheduled demolition, and they were watching from a safe distance. We are not here today to discuss ancient history for the sake of nostalgia. We are here because the signal has just flashed red again. The magnitude of insider selling we are witnessing right now, in the current fiscal year, dwarfs anything seen before 1929 or 2008. The names have changed, but the maneuver is identical. Jeff Bezos, Mark Zuckerberg, the Walton family, the Jamie Dimons of the banking world. They are not accumulating. They are dumping stock at a pace that defies standard portfolio rebalancing. They are generating cash piles that are historically unprecedented. While the media distracts the Western world with culture wars and promises of an artificial intelligence utopia, the balance sheets of the ruling class are screaming that the cycle has ended. They are preparing for a liquidity event. This video is not a prediction. We do not deal in crystal balls. We deal in data. Over the next few minutes, we are going to dissect the portfolio shifts of the Western elite with forensic precision. We will look at the SEC filings they hope you never read. We will prove that the coming financial reset is not just a possibility. It is a mathematical certainty that has already been priced in by those who own the casino. The crash is already scheduled. The exits are already crowded. And if you do not understand why the smartest money in the room is fleeing to safety, it is because you are the exit liquidity they need to close their positions. To understand the gravity of the situation, we must first validate the dissonance you feel every time you look at your bank account. There is a profound disconnect in the Western world today. You are told by the government that the economy is robust. You are shown charts of the S&P 500 and the Nasdaq hitting all-time highs. You are told that unemployment is low and that the soft landing has been achieved. Yet when you go to the grocery store, the math does not add up. When you look at rent prices, insurance premiums, and the cost of servicing debt, the narrative of prosperity collapses. You feel that the system is rigged. This is not a feeling, it is a fact. The modern stock market has detached from the reality of the real economy. It has become a pressurized chamber of asset inflation, fueled by currency debasement, designed to benefit those who own assets at the expense of those who earn wages. The wealth you see on the news is a mirage of printed money, and the anxiety you feel is your subconscious recognizing that the bill is coming due. We need to define a crucial concept: exit liquidity. In the world of high finance, liquidity is the ability to sell an asset without tanking its price. If you own 10 shares of a company, you can sell them instantly. If you own 10 million shares, you have a problem. If you try to sell them all at once, the price collapses, and you destroy your own fortune. To sell 10 million shares, you need 10 million shares worth of buyers. You need a crowd. You need euphoria. You need a sucker at the table. This is the dark mechanic of the market cycle. For the billionaire class to realize their gains, to turn paper wealth into hard assets like land, gold, and commodities, they need the middle class to buy their paper at the top. They need you to believe that the market will go up forever. They need you to put your 401k, your savings, and your stimulus checks into the very assets they are desperate to offload. This is where the technocratic elite and the corporate media apparatus perform their essential function. Their role is not to inform you. Their role is to manufacture consent and market sentiment. When the insiders are buying, the news is terrifying, driving prices down so they can accumulate cheap assets. When the insiders are selling, like they are right now, the news is euphoric. They invent narratives. The Roaring Twenties, the new economy, the AI revolution. These narratives serve one purpose: to keep the retail investor buying while the smart money sells. They keep the music playing so the insiders can find a chair before the music stops. The pundits on television telling you to buy the dip are the marketing department for the exit strategy of the ultra-wealthy. They are soliciting the capital of the working class to cash out the ruling class. We must stop viewing a financial crash as an error in the system. It is not a bug, it is a feature. A crash is a harvest. It is the mechanism by which the system resets. It is a wealth transfer event. During a crash, assets move from weak hands, debtors, leveraged speculators, and the unprepared middle class, to strong hands, those with cash reserves and no debt. The crash is designed to reacquire real assets at rock-bottom prices from bankrupt families and failed businesses. The inflation you are suffering now was the setup. The crash that is coming is the foreclosure. The anxiety you feel is justified because the system is currently in the final phase of the trap. They have inflated the balloon. They are currently selling their positions, and soon they will hand you the needle. We now submit into Evidence Exhibit A, the Great Crash of 1929. In the sanitized history books provided by the state education system, this event is portrayed as an unfortunate accident, a perfect storm of optimism gone wrong, a sudden thunderclap from a clear blue sky that caught the innocent banking establishment by surprise. This is a fabrication. To the forensic historian, 1929 was not an accident. It was a controlled demolition. It was a mathematical inevitability engineered by the very architects who claimed to be blindsided by it. To understand the mechanics of this crime, one must strip away the nostalgia of the Roaring Twenties and look at the liquidity structure. Phase 1 of the pattern is the trap, historically known as the hype. The narrative constructed in the late 1920s was a masterpiece of psychological warfare. The establishment economists, the ancestors of today's pundits, declared that the American economy had reached a permanently high plateau. They argued that the old cycles of boom and bust had been conquered by modern industrial efficiency. This narrative was the bait. The average American, intoxicated by this propaganda and the new availability of margin lending, did not just invest their savings, they leveraged their existence. They were allowed to buy stocks with 10% cash and 90% debt. The butcher, the baker, and the mechanic were all exposed to the market, believing they had discovered a perpetual money machine. The euphoria was absolute. But forensic analysis reveals that the market was no longer pricing in value or earnings. It was pricing in the maximum amount of debt the public could bear. The shoeshine boy giving stock tips is not just a colorful anecdote. It is a terminal metric. It indicates market saturation. When the lowest capital class is fully deployed, there is no new liquidity left to enter the system. The Ponzi scheme has run out of greater fools. While the public was drunk on easy credit, Phase 2, the smart exit, was already being executed with cold precision. The behavior of the titans of industry in 1928 and early 1929 stands in terrifying contrast to the retail mania. We have the transaction records. Bernard Baruch, the legendary financier, did not wait for the crash. He looked at the math, saw the saturation, and sold everything. He moved his massive fortune into golden bonds. Joseph Kennedy, the patriarch of the political dynasty, famously exited the market entirely long before Black Thursday. These men were not lucky. They had access to the order flow. They could see that the volume of buying was drying up while the volume of debt was skyrocketing. They understood the physics of the market. When the insiders sell, the price is maintained only by the momentum of the ignorant. They quietly offloaded their risk onto the euphoric middle class, turning their paper profits into hard, tangible wealth, while leaving the public holding certificates that were about to become worthless. Then came the trigger. On Black Thursday, the liquidity evaporated. This is the moment the trap snaps shut. It wasn't just that prices fell, it was that bids disappeared. When the selling began, the margin debt that fueled the rise accelerated the collapse. Margin calls went out. The brokers demanded cash that the retail investors did not have. To cover their debts, the middle class was forced to sell their stocks at any price, driving the market down further, triggering more margin calls in a catastrophic feedback loop. The paper wealth of the Roaring Twenties vanished in days. But, and this is the critical point, the wealth did not disappear from the earth. Wealth cannot be destroyed. It can only be transferred. The conclusion of this case study reveals the brutal truth of the economic cycle. The Great Depression was not a tragedy for the elite. For those who had exited to cash, the Rockefellers, the Kennedys, the Morgans, the crash was the greatest acquisition event in American history. They waited for the bottom, and then they used their preserved capital to buy up America's infrastructure, real estate, and corporations for pennies on the dollar. They bought the United States at a 90% discount. The crash decimated the middle class and the speculative new money, but it consolidated the power of the old money. It was a transfer of ownership. The lesson of 1929 is undeniable and stands as our first proof. The crash is the method by which the elite repossessed the nation from the public. The pattern established in 1929 is not a historical anomaly. It is the operating system of the Western financial markets. We see this sequence repeated with algorithmic precision in every subsequent disaster. The technology changes, the speed increases, the jargon becomes more complex, but the crime remains the same. Let us examine the forensic dossiers for 1987 and 2008 to prove that the silent shift is a recurring phenomenon. Case Study 2, Black Monday, 1987. The media and the financial establishment have spent decades blaming this event on program trading and computer glitches. They claim the algorithms malfunctioned. This is a convenient lie designed to mask the intent. The forensic reality is that the market had once again detached from fundamental reality. In the months leading up to October 1987, insider selling had reached a fever pitch. The smart money saw the rising interest rates and the unsustainable valuations. They utilized the newly invented portfolio insurance mechanisms not to protect the market, but to facilitate their own exit. They distributed their shares to a retail public that was just starting to embrace the yuppie culture of the stock market in the greed-fueled 80s. When the exit was complete, the support was pulled. The 1987 crash was a technical slaughter, a rapid repricing that wiped out the latecomers, while the architects of the rally sat in cash, ready to buy the wreckage. It was a test run for the digital age of looting. Case Study 3, the global financial crisis of 2008. This is the smoking gun for the modern era. The scale of the betrayal here is industrial. The smart money did not just sell. They actively bet against the products they sold to you. We have the internal emails. We have the congressional testimony. Hedge fund managers and bank CEOs knew the subprime mortgage bonds were toxic waste. They famously described them as garbage, a nuclear holocaust in private communications. Yet, publicly, they stamped them with AAA ratings and sold them to pension funds, teachers' retirement accounts, and municipal governments. They were selling fire insurance while they were arsonists in the basement lighting the matches. The pattern holds with terrifying accuracy. Phase 1, the hype. The narrative was real estate never goes down. The public was encouraged to take on massive debt, buying multiple homes with zero money down. Phase 2, the exit. While the public was buying houses they couldn't afford, the bank CEOs were cashing out stock options and securing golden parachutes. They were shorting their own market. When the collapse came, it wasn't just a market correction, it was a systemic insolvency. But unlike 1929, the 2008 cycle introduced a new, darker element, the bailout. The central bank, the Federal Reserve, stepped in to ensure that while the public lost their homes, the perpetrators did not lose their banks. The debt was socialized, the profits were privatized. The smart money shifted the bag to the taxpayer. The conclusion of these proofs is overwhelming. 1929, 1987, 2008. Three distinct eras, three distinct technologies, but the mechanism is identical. Insider selling peaks, media hype peaks, market collapses, wealth transfers. The smart money is never the victim. They are the authors of the cycle. They do not panic, they execute. And as we look at the data for the current year, the silent shift is no longer silent. It is deafening. The exact same indicators that flashed before Black Thursday and the Great Recession are flashing now. The prosecution rests on history. We must now turn our eyes to the present crime scene. We now arrive at the verdict. We have established the historical precedent. We have proven the mechanism of the crime. Now, we must open the case file on the present moment. We must look at the evidence surrounding the Western economy right now, in the current fiscal quarter. If you are holding stocks, if you have a pension, if you believe your home value is safe, look at the screen. The prosecution calls the SEC filings to the stand. The silent shift is currently operating at maximum velocity. The insiders, the individuals who have the most intimate knowledge of the global economy, supply chains, and consumer health, are engaging in a liquidation event that rivals the exits of 1929 and 2007. Let us begin the apocalypse checklist. Phase 1 of the pattern requires a euphoric distraction to provide cover for the exit. In 1929, it was the radio and the new era. In 2000, it was the dot-com boom. Today, the distraction is artificial intelligence. The narrative being sold to the Western public is that AI will unleash a productivity boom so massive that valuations no longer matter. The retail investor is chasing this narrative, pouring billions into a handful of tech stocks, driving indices to record highs despite falling earnings in the real economy. Is the retail class euphoric and fully deployed? Check. Phase 2 requires the smart money exit. Let us look at the specific transactions. Mark Zuckerberg has sold hundreds of millions of dollars worth of Meta stock in the last year, his first sales in 2 years. Jeff Bezos has offloaded billions in Amazon stock. The Walton family, heirs to the Walmart empire, a proxy for the American consumer, has sold billions in stock. Jamie Dimon, the CEO of JP Morgan Chase, the most important banker in the Western world, sold shares for the first time in his entire tenure at the bank. These men do not need the money for lifestyle expenses. They are cashing out. They are taking chips off the table. Is the insider exit occurring at a historic rate? Check. But the most damning piece of evidence comes from the Oracle of Omaha himself, Warren Buffett. Buffett is not a speculator. He is a value investor. He buys when there is blood in the streets. So what is he doing now? He is selling. He has slashed his massive position in Apple. He has reduced his exposure to the banking sector. And most importantly, his conglomerate Berkshire Hathaway is currently sitting on the largest pile of cash and treasury bills in its history, hundreds of billions of dollars sitting on the sidelines. Why does the greatest investor in history hold record cash during a record bull market? Because he knows the math. He knows the valuations are fake. He knows the soft landing is a myth. He is building a war chest to buy your assets when they go on sale. Is the smart money hoarding cash for a collapse? Confirmed. The verdict is not a probability, it is a declared state of emergency. We are not approaching the cliff. We have already driven off it like Wile E. Coyote, and we are simply waiting for gravity to notice. The transfer of wealth is already in its final stage. The billionaires have secured their lifeboats. They have locked in their gains at the top of the market, funded by your pension contributions and your retail brokerage accounts. The doors to the exit are now locking. The liquidity is drying up. The trap has been set and the Western world is currently standing directly on the X. We conclude with the final analysis of your position. At this stage, the human mind attempts to bargain. You are likely experiencing the false hope reflex. You might be thinking, but the Federal Reserve will pivot. You might be thinking, it's an election year. They won't let the market crash. You might be thinking, technology is different this time. Productivity will save us. These are comforting lies. These are the same lies the citizens of Rome told themselves before the sack. These are the same lies the investors of 1929 told themselves before the Depression. The hard truth is that the mathematics of the debt cycle do not care about your optimism. They do not care about your political affiliation. The Western world is drowning in a level of sovereign and private debt that is mathematically unpayable. The interest payments alone are consuming the tax revenue. The soft landing narrative is a sedative administered to the patient so they do not thrash while the surgery is performed. The technocratic elite know that the only way to resolve this debt is through a massive devaluation of the currency and a deflationary collapse of asset prices. They are not trying to save the system for you. They are managing the controlled demolition to ensure they remain on top of the rubble. The cycle is not a possibility, it is an inevitability, but the outcome for you is not yet written. History shows that in every collapse, there is a minority that survives and even thrives. They are not the smartest or the strongest, they are simply the informed. They are the ones who ignored the noise of the corporate media and watched the signals of the silent money. They are the ones who understood that when the billionaires sell, it is time to stop buying. This channel exists for one purpose: to bridge the information gap between the predator class and the prey. We dissect the signals they try to hide. We analyze the geopolitics they try to obscure. We provide the forensic accounting of the decline of the West. If you want to continue believing the comfortable lies of the establishment, close this video and go back to sleep. But if you want to survive what is coming, if you want to understand the mechanics of the greatest wealth transfer in human history, and if you refuse to be the exit liquidity for a corrupt elite, then you must subscribe. Because when Phase X arrives and the ATMs stop working, you will want to know why. The answers are in the past. The preparation must be in the present. Class dismissed.